On the surface, the global banking industry has never looked stronger. In the last reporting cycle, banks collectively clocked a record-breaking $1.2 trillion in profits. This isn't just a good year, it's a historic peak, a testament to the sheer scale and reach of the financial system. To put that into perspective, it's the highest profit pool of any industry on the planet. The numbers that have long defined institutional health seem to tell a story of unassailable strength. Return on equity, a core measure of profitability, is holding steady at a healthy 10.3%. Capital ratios, the bedrock of regulatory stability, are robust, averaging around 13%, well above required minimums. And in a rising rate environment, margins have been undeniably strong. By every traditional metric, banks appear to be in an enviable position. And yet, the market's yawning. The applause is conspicuously absent. Despite these record profits, bank stocks are trading at a nearly 70% discount to other sectors. This isn't a minor discrepancy, it's a chasm of doubt. Why? Because sophisticated investors see these profits for what they are. A temporary windfall driven by interest rate hikes, not a fundamental, sustainable advantage. They believe these profits are a feature of the last economic cycle, not a forever thing. They're right to be skeptical, because the next decade is poised to flip the script entirely, driven by a force that will redefine value in financial services. Our analysis shows that AI, specifically generative and agentic AI, could erase up to $170 billion in annual banking profits if incumbent players don't adapt, and fast. This isn't a distant, theoretical threat. It's an imminent margin compression event. Imagine this: your personal AI agent constantly scanning the market on your behalf. It will find and steer customers to better offers on loans, deposits, and credit cards in seconds. This happens at machine speed, far faster than slow-moving, committee-driven banks can possibly react. The traditional barriers to switching, apathy, complexity, and lack of transparency, are about to be vaporized by technology. So where will the first hits land? The most vulnerable and profitable retail products will be first. For credit cards, a bastion of bank profitability, the profit pools could drop by as much as 34% as AI agents arbitrage away high APRs and fees. Next, consumer deposits. The inertia that kept trillions in low-yield checking accounts will evaporate. We project profit pools here could drop by 27% as AI seamlessly moves customer cash to the highest bidder. The reflexive response from many executives will be to slash costs. But in this new paradigm, cost cuts won't save you. Yes, it's true that AI can knock 15 to 20% off your operational cost base. These are real, tangible savings from automating workflows and augmenting human capabilities. But this is a defensive move, not a winning strategy. When every competitor adopts the same technology, the advantages compress. It becomes table stakes, and in a transparent, AI-driven market, those savings are inevitably competed away and passed on to customers in the form of lower prices and better rates. Meanwhile, the very foundation of retail banking, customer loyalty, is cracked. The old assumption that a primary checking account created a sticky, lifelong relationship is now dangerously outdated. Consider this: in the US, only 4% of new checking account customers now stick with their existing primary bank without shopping around for alternatives. That figure is down from 25% in just 2018. This is a five-fold increase in promiscuous behavior in just a few years. The default is no longer loyalty, it's active, continuous evaluation. And customers are telling us exactly what they want. Our research shows that the vast majority of people want powerful AI tools integrated directly into their primary banking app. They want a partner, not just a ball. And here's the kicker: nearly all of them say they will switch banks to get them. The threat of attrition is real, and the demand for innovation is a mandate. So, in a world where scale is commoditized and loyalty is fleeting, what wins? The answer is precision, not heft. Precision beats scale when AI gives you the ability to aim every single decision, every offer, every risk assessment, every capital allocation with surgical accuracy. It's about making a million perfect small decisions, not one imperfect large one. To win in this new era, leaders must master a precision toolbox. It's a framework built across 4 critical moves. First, technology. This means going beyond chatbots. It means building a truly agentic AI workforce. Picture an operating model where one human supervisor orchestrates 20 to 30 autonomous agents, each capable of running complex end-to-end workflows with minimal intervention. This is the key to unlocking radical productivity. This isn't science fiction. The leaders in the industry are already making massive, multi-billion-dollar investments to build these capabilities right now. Second, you must reorient your entire organization around the new consumer. This consumer is mobile first. The branch is in their pocket. Your primary interface must be flawless, intuitive, and fast. They expect hyper-personalization. Not just their name on an email, but proactive, predictive offers that anticipate their needs before they even articulate them. And they demand AI-guided experiences that blend the seamless ease of digital with the irreplaceable value of human trust. The goal is to automate the predictable and humanize the exceptional. The third move is a radical focus on capital efficiency. In a world of compressed margins, the laziest dollar on your balance sheet is a liability. You must use AI to price risk with surgical accuracy and allocate your balance sheet like a sniper, not a shotgun, targeting only the most profitable and strategically aligned opportunities. And fourth, a new approach to M&A. The era of empire building, of buying scale for scale's sake, is over. The future is targeted M&A, acquiring specific capabilities, technologies, or data assets that you can't build fast enough yourself. Buy the puzzle piece you're missing. Don't buy another puzzle. As you consider these moves, never forget the scale of the prize. Remember, this global banking system intermediates an astonishing $426 trillion in assets. That is nearly 4 times the entire global GDP. It is the circulatory system of the world economy. And what's more, it's a system that has grown faster than the underlying economy since 2019. The pie is not just massive, it's expanding. The opportunity is therefore massive. This isn't just about defending your current position, it's about capturing a disproportionate share of value in the coming reallocation. If I were running a bank today, I would bet everything on building a culture of precision. This isn't just a technology problem. It's a strategic and organizational mandate. It starts with 3 core pillars. First, data. You must obsess over creating a single source of truth. Clean, accessible, real-time data is the fuel for every AI model and every precision decision. Second, models. You need to invest in the talent and platforms to build, validate, and deploy thousands of predictive models across the organization, from marketing to risk to operations. And third, you must embed rapid test and learn loops into your culture. The winners will be those who can run thousands of experiments a week, constantly iterating and optimizing every aspect of their business. Because in the age of AI, scale is merely table stakes. It gets you a seat at the table, but it doesn't guarantee you'll win the hand. Precision is the new, decisive edge. The forces of compression are already in motion. The choice is simple. Embrace precision and capture the future, or cling to scale and watch your margin vanish. Move now.